Picture this scene. You are seated at your dining room table. Your cup of tea has gone lukewarm. You just tore open an envelope from the Internal Revenue Service, and the notice inside declares you owe a financial penalty. A serious one, 6% each and every year, on funds you believed were working in your favor. You look at the figure, you feel your stomach drop. You followed every step you thought was correct. You deposited money into your retirement savings. You trusted that financial planner. You even viewed clips online that promised the IRS would reward you with over $100,000 simply for putting money to work. But not a single person warned you about the one provision you overlooked. And today, the IRS is demanding that money back, plus penalties on top. Do not go anywhere, because right now, I am going to ensure this situation never touches your life. I am Jocelyn, and this channel was built with a single purpose: to guarantee that you, whether you are already retired or getting close to it, grasp the actual regulations before you stumble into an expensive error. Now, you have most likely encountered thumbnails and headlines claiming the IRS will hand you $100,000 or beyond to place money into specific investments. Let me speak to you with complete transparency. The IRS does not mail you a payment for investing. That is simply not the reality. What the IRS does provide are genuinely significant, genuinely impactful tax advantages, write-offs, credits, postponements. And absolutely, if you apply them properly across time, the accumulated tax relief can certainly surpass $100,000. But here is the detail everyone leaves out. There are pitfalls buried within every single one of these advantages, and if you are unaware of them, you will not be keeping money. You will be losing money. So right now, I am going to guide you through 4 genuine investments that the IRS incentivizes you to pursue. I am going to break down the official regulations directly from IRS.gov. And I am going to reveal the blunders that activate penalties. Please remain with me through the final moment, because the 4th investment is entirely new for 2025. Millions of older Americans qualify for it, and the vast majority have no clue it even exists yet. Let me share the story of Robert. Robert is 62 years of age. He still does part-time consulting work. He participates in a 401k offered by his employer, and he also established a traditional IRA several years back. Robert came across a video online explaining that individuals his age could put additional funds into their retirement savings, a feature known as the super catch-up. And that video described it as though the IRS was essentially paying you to save. So Robert became enthusiastic. He contributed the maximum to his 401k. He deposited the entire $35,750 because he learned that workers between 60 and 63 qualify for an elevated catch-up threshold. On top of that, he also directed $8,600 into his traditional IRA. His thinking was simple: greater deductions, greater tax relief. But this is precisely where Robert went wrong. Robert's earnings were too substantial. Because he was simultaneously enrolled in his employer's 401k program, the ability to deduct his traditional IRA contribution was entirely eliminated at his earnings level. He never verified the IRS income thresholds. So that IRA deposit, it produced 0 deductions. Not one single penny was deductible. But that is still not the worst outcome. Robert had also inadvertently deposited $500 beyond what the IRA ceiling permitted. He was unaware that the catch-up figure had been adjusted, and that surplus just remained sitting in his account. The IRS imposed a 6% penalty on him, not a single occurrence. Every consecutive year, that surplus money lingered in his IRA. Robert was convinced he was strengthening his retirement. In reality, he was constructing a tax nightmare. And the most heartbreaking detail? If Robert had merely consulted IRS Publication 590A or utilized the IRS withholding calculator, he would have understood precisely what was and was not eligible for a deduction. I refuse to let this happen to you. So allow me to guide you through all 4 investments done the correct way. Investment number 1, tax-favored retirement savings plans. This covers your 401k, your 403b, your 4957b, and your traditional or Roth IRA. These are the actual figures for 2026, pulled directly from the IRS. The standard 401k contribution ceiling is $24,500. If your age falls between 50 and 59, or you are 64 and beyond, you may add an extra $8,000 through catch-up contributions. That pushes your combined total to $32,500. But here is the major highlight. If your age falls between 60 and 63, the Secure 2.0 Act introduced what is termed the Super Catch-up. You are permitted to deposit an additional $11,250. That means your combined 401k contribution can climb to $35,750 within one calendar year. For IRAs, the 2026 ceiling is $7,500. If your age is 50 or above, you may add $1,100, pushing it to $8,600. And here is a detail that surprises many people. Beginning in 2020, there is zero age restriction on IRA contributions. If you are 70, 75, or 80 years of age and you continue earning taxable compensation, you are permitted to contribute. So then, what is the actual tax advantage? When you deposit funds into a traditional 401k or traditional IRA, that deposit lowers your taxable earnings. If you fall within the 22% tax bracket and you deposit $24,500, you reduce your tax burden by approximately $5,390 for that particular year. Across 15 or 20 years of repeating this, those reductions accumulate dramatically. That is the pathway to realistically surpassing $100,000 in overall tax relief. But it demands patience, it demands discipline, and it demands adhering to the guidelines precisely. The pitfall? Going beyond your contribution ceilings activates a 6% excise levy. Every year, the surplus remains in your account. And for 401k accounts, if excess deferrals are not resolved by April 15th of the subsequent year, those funds get taxed a second time, once during the contribution year itself, and once more when ultimately withdrawn. One additional note: if you are a retiree with modest income, do not overlook Form 8880. The Savers Credit can provide you with a bonus tax credit worth up to $1,000 or $2,000 for married couples, layered on top of your deduction. Investment number 2, Qualified Opportunity Zone Funds. This particular option is incredibly potent, but it is also the most widely misinterpreted. Here is the fundamental concept. If you dispose of a stock, a piece of real estate, or a business venture, and you generate a capital gain, you would typically owe taxes on that profit immediately. But the IRS provides that if you channel that profit into a qualified opportunity fund within 180 days, you may postpone that tax obligation. And the more time you maintain it, the greater your reward becomes. Maintain it for 5 years, your investment basis grows by 10% of the initially postponed gain. Maintain it for 7 years, it grows by yet another 5%. That amounts to 15% of your starting gain that you will never be taxed on. But here is where the opportunity becomes truly remarkable. Maintain that position for 10 years or beyond, and you may choose to permanently shield all of the growth on the opportunity zone holding itself, not merely the starting gain, the appreciation, completely tax-free. Now, the One Big Beautiful Bill, enacted into law on July 4th, 2025, strengthened this further for rural communities. More than 3,300 qualified opportunity zones have been classified as rural, and the substantial improvement requirement for real estate in those rural zones was reduced by half, from 100% down to 50%. But here are the pitfalls you absolutely need to understand. First, you are not permitted to simply purchase real estate in an economically struggling area and label it an opportunity zone holding. You must channel your investment through a qualified opportunity fund that submits Form 8996 to the IRS. No formal fund entity, no tax advantage whatsoever. Second, you are required to commit your funds within 180 days of generating your gain. Let that deadline slip, and the postponement vanishes. For good. Third, and this is the detail that blindsides most investors, the initial gain you postponed, it must be reported no later than December 31st, 2026. That date is rapidly approaching. The postponement is not permanent. Only the growth on the fund holding itself may be permanently shielded after a decade. And you are obligated to submit Form 8997 each and every year you maintain a qualified opportunity fund position. Skip one submission. You risk undermining your complete postponement. Investment number 3, health savings accounts, the HSA. I consider this the quiet fortune builder, and the majority of older Americans either overlook it or get confused by it. An HSA delivers what tax experts describe as a triple tax benefit. Benefit 1, your deposits are tax deductible. Benefit 2, your balance appreciates tax-free within the account. And benefit 3, When you withdraw it to cover eligible medical costs, that distribution is likewise tax-free. No alternative account anywhere in the entire tax code provides you with all three simultaneously. For 2026, the deposit ceilings are $4,400 for individual coverage and $8,750 for household coverage. If your age is 55 or above, you may contribute an additional $1,000. And here is what shifted under the One Big Beautiful Bill. Commencing in 2026, bronze and catastrophic health insurance options now meet HSA compatibility standards. That means a larger pool of people qualify than at any previous point. Direct primary care plans now meet the criteria as well. And telehealth services received before satisfying your deductible are now permanently allowed without threatening your HSA eligibility. Now, here is the element that escapes most people entirely. You are able to place your HSA dollars into stocks, bonds, and mutual funds, precisely like a retirement savings vehicle, and the appreciation is entirely shielded from taxes. If you contribute the maximum family amount plus the catch-up from age 55 through 65, you deposit close to $100,000 across that 10-year span. Factor in investment appreciation, and the combined tax relief from deposits, growth, and healthcare withdrawals can unquestionably surpass $100,000 across your lifetime. But here is the pitfall, and it is a significant one. The instant you sign up for Medicare, including Part A, you become permanently ineligible to deposit into an HSA. And here is the detail that traps people. Medicare Part A may be applied retroactively up to 6 months. So, if you activated Medicare and it was backdated, you may have unintentionally generated excess deposits for those particular months. Surplus HSA deposits face a 6% levy each year, and if you tap your HSA dollars for non-healthcare costs before reaching 65, that withdrawal gets classified as taxable earnings and struck with a 20% supplemental penalty. 20%. Beyond 65, non-healthcare withdrawals get taxed similarly to an IRA, but thankfully, the penalty is eliminated. You are required to document your HSA transactions on Form 8889 each year. Investment number 4, and this is the completely new provision. The enhanced senior deduction and qualified charitable distributions. Through the One Big Beautiful Bill enacted into law July 4th, 2025, an entirely fresh deduction was established exclusively for Americans who are 65 and beyond. If your age is 65 or above, you may now apply an additional $6,000 deduction on your 2025 tax filing. If you are married and each spouse has reached 65 or beyond, that amount increases to $12,000. This sits on top of your current standard deduction. Let me illustrate what that translates to in actual dollar amounts. For an individual filer, age 65 and above, your standard deduction for 2025 stands at $17,750. Layer on the new senior deduction, and you could protect as much as $23,750 from taxation. For a married couple where each spouse has reached 65 or beyond, your standard deduction amounts to $34,700. Combine the senior deduction, and your combined total climbs to $46,700. That represents $46,700 of earnings that the IRS has no authority to tax. But a phase-out exists. This deduction starts to diminish if your modified adjusted gross income surpasses $75,000 for individual filers or $150,000 for couples filing jointly. And if your earnings surpass $175,000 individually or $250,000 jointly, you receive absolutely nothing. Additionally, this deduction has an expiration date. It covers only tax years 2025 through 2028. Beyond that point, unless legislators vote to continue it, the benefit vanishes. You report it on the newly created Schedule 1A, Additional Deductions. Now, let me explain the complementary component. Qualified charitable distributions. If your age is 70 and a half or beyond, you may transfer up to $111,000 in 2026 straight from your traditional IRA to an eligible charitable organization. That sum gets completely removed from your taxable earnings, and it satisfies your required minimum distribution obligation. You are not even required to itemize to gain this advantage. But here is the essential pitfall. The funds must transfer directly from your IRA administrator to the charitable organization. If the dollars pass through your personal checking account, even for 24 hours, the complete distribution converts to taxable earnings. It makes no difference if you forward it to the charity the following day. The IRS categorizes it as a standard withdrawal. And if your age exceeds 73, and this represents your required minimum distribution, that newly taxable withdrawal might elevate you into a steeper bracket and set off increased Medicare Part B costs through what is known as an IRMAA adjustment. One final detail: QCDs may only originate from a traditional IRA, not from a 401k, not from a 403b, not from a Roth IRA, exclusively from a traditional IRA. Very well. You have now absorbed more insight about these 4 tax-advantaged investments than the majority of financial planners convey in a 60-minute consultation. But understanding without execution offers you no shield. So here are your 3 action items, and I urge you to treat these with full seriousness. Step number 1, confirm your contribution ceilings before you deposit even $1. Navigate to IRS.gov, search for the COLA adjustments page for the present year, validate your 401k ceiling, your IRA ceiling, and your HSA ceiling. If your age falls between 60 and 63, verify that you meet the Super Catch-up requirements. Do not depend on a YouTube clip or a social media update. Go directly to the original authority, the IRS website. If you maintain an IRA and you or your spouse is enrolled in a workplace retirement program, review the IRA deduction thresholds page on IRS.gov. There are earnings phase-out brackets that shift annually. Making an error here means you collect 0 deductions and could encounter penalties. Step number 2, submit the proper paperwork each and every year. If you maintain an HSA, submit Form 8889. If you possess a Qualified Opportunity Fund holding, submit Form 8997 on an annual basis. If you are utilizing the new senior deduction, complete the new Schedule 1A. If you executed a qualified charitable distribution, verify that your Form 1099-R carries the correct designation and retain written confirmation from the charitable organization. Overlooking even a single one of these documents can eliminate your tax advantage completely. Or even worse, generate an IRS compliance notification. Step number 3, shield yourself against fraud. The IRS published an advisory in March 2026. Fraudsters are building counterfeit tax deduction calculators that capitalize on the recent One Big Beautiful Bill legislative changes. They guarantee enormous refunds. They request your social security number, your financial account details, your date of birth. The IRS stated it plainly, and I am quoting directly: any tool promising a guaranteed big payday is likely a phishing attempt. Exclusively use websites ending in .gov. If you encounter a calculator on the internet guaranteeing you $100,000 from the IRS, shut that window without hesitation. Flag it at phishing at IRS.gov. The IRS does not compensate you for investing. It permits you to shrink your tax obligation when you invest strategically. There is a critically important distinction between those concepts. I need to speak candidly with you for a brief moment. The regulations we explored today, the deposit ceilings, the income phase-outs, the filing deadlines, they shift with each passing year. What holds true today could be entirely different by next January, and here is what concerns me deeply. YouTube may never surface my upcoming video for you. The platform's algorithm dictates what appears on your screen. Alerts get lost in the shuffle, and by the moment you discover a regulation has shifted, the window may already have closed. That is precisely the reason I built something specifically for you. Beneath this video in the description area, there is a direct link to the Global Senior Alerts official WhatsApp channel. Once you join, you will gain access to download a complimentary senior benefits protection guide. It addresses Social Security regulations, pension taxation pitfalls, Medicare filing windows, banking safeguards, and the precise documents you must submit for every advantage we covered in today's discussion. You will additionally receive instant notifications each time a regulation shifts. No platform algorithms, no uncertainty, simply verified information delivered straight to you precisely when it counts. This is not a promotional pitch. There is absolutely nothing to purchase. This is purely about guaranteeing you are never blindsided by a provision you had no awareness of. Because the federal government does not arrive at your doorstep to walk you through these matters. They post the regulations on their official site and assume you will locate them independently. And whenever you overlook something, they dispatch a penalty notification. That is not equitable. But that is the existing reality. So allow me to help you remain one step ahead of it. Tap the link in the description, connect with the WhatsApp channel, retrieve the complimentary guide, and pass this video along to someone dear to you who has passed 60. A mother or father, a life partner, a neighbor down the street, a companion from your place of worship, anybody who has earned the right to understand these regulations before committing an error that cannot be reversed. I am Jocelyn, and I will be with you again in the next installment. Stay educated, stay shielded, and never allow anyone to convince you the IRS is going to deliver a payment to your mailbox. What they will do is permit you to retain a larger portion of your own earnings, but exclusively if you honor the regulations. Look after yourself.